Alright, so class, so we're starting chapter 7. Chapter 7 is on risk and rates of return. Alright, so in this chapter we'll be learning when a company, when an individual take a risk. Alright, the risk has to be, there's a meaning behind a risk. Alright, it means when you take a high risk, you expect to get a higher return. Alright, when you're taking a lower risk, you expect to get a lower return. So we're gonna see what kind of relationship or what are the tools we can use in order to get the results, right? So what we're gonna learn in chapter 7 would be the standalone risk, all right? Then the expected return, risk and rates of return, all right, using the capital asset pricing formula, and then how we're going to use some other formulas to calculate valuation of shares as well. All right, so let's start. Okay, let's start with understanding the definition behind risk. All right, so risk in traditional terms is viewed as a negative. All right, if you look at the dictionary, it's usually you consider risk means negative. Are you taking risk? When people ask, are you going to take the risk, they are looking at the negative connotation of that. All right, it means it's not something positive. All right, it is something negative. That's even stated in the dictionary as exposing to danger or hazard. All right, so in the dictionary is shown as exposing to danger or hazard. Okay, so that is a definition of risk. But if you look at Chinese symbol of risk, all right, there are two syllables over here. All right, the Chinese symbols of risk reproduced below give much better description of the risk. All right, so this is the first symbol. All right, is danger. All right, the first symbol of risk, all right, in the definition which is in Chinese, the first definition is danger, while the second symbol is for opportunity. All right, so making risk a mix of danger and opportunity. So you cannot have one without the other. So I find this as a better definition when it comes to risk. All right, without encountering danger, without encountering a challenge, all right, there won't be an opportunity. So that is, I feel, a better definition for risk, right? Not is as seen as totally negative. So risk is therefore neither good nor bad. It's just a fact of life. The question that businesses have to address is therefore not whether to avoid risk, but how best to incorporate it into their decision making. So this is very important. All right, companies should not immediately talk about how to avoid risk, but it's always how to incorporate the risk, how to manage and mitigate the risk. All right, because when you're doing business, you have to talk about taking opportunities. All right, so when you build business, you have to take opportunities. Therefore, you can't totally avoid risk when you are taking opportunities. So you have to learn how to mitigate the risk. Okay, so let's look at how good risk and return models should be. All right, the first point would be it should come up with a measure of risk that applies to all assets, not be asset specific. All right, so in a company, all right, let's say you have different types of assets. You could have cash, you could have machineries, you could have a land, you could have a property. When you talk about a risk and return model, you should not only manage risk for specific asset. It means you have certain rules when it comes to managing cash. All right, but when it comes to other properties, you don't have any rules, any ways to manage it. So that is not right. Every asset has to be mitigated, has to manage well, not just one specific asset. Same goes to like companies. All right, they only talk about how to manage the profit. All right, how to manage the profit, but they're not looking at the other aspects like the revenue, the cost, the productivity or the staff retention. So you have to look the holistically, right? So that is the first point. It should not be just one specific asset. All right, it should be overall. The next one, it should clearly define what types of risk are rewarded and what are not. All right, and provide a rationale for the delineation. It means if a company, all right, the staff taking risk, all right, if they're taking risk, it has to have a how to say this. Okay, if a company is taking risk, it has to be measurable. Not only is it measurable, you have to take risk when there is a need for it. You cannot simply take any amount of risk and expect to be rewarded. Alright, if let's say you're an investment bank, alright, so you are executive, one of the executive. You cannot just take high risk in order to get better reward, better bonus. Alright, the risk has to be reasonable. Alright, your risk has to be reasonable for the same reward you're going to reap out of it. You cannot simply take any amount of risk. Alright, and the next one, it should come out with a standardized risk measure. An investor presented with a risk measure for an individual asset should be able to draw a conclusion about whether the asset is above average or below average risk. Okay, what does it mean? Okay, for a company, let's say you need to have a metrics, like let's say the performance of the machine, 1 to 10. If I say above 5, alright, 6, 7, 8, 9, 10, if I'm getting the metrics above 5, that means the machine is working well. Below 5, that means the machine is poorly performing. Alright, so I must have a standardized measure. I cannot say, oh, the machine is good, or the next day is, oh, the machine is performing poorly. You cannot simply say that. You need to have a metrics. Alright, you must say that, okay, above 5, today the performance is good, it's 7. Alright, the status is such. So you need to have a metrics. It's just like we're having a ratio, right? Remember, when we study ratio, it's like current ratio means more than 2, that means it's good. Below than 2, it means it's poor. Alright, poor liquidity. Same goes to this. Alright, you must have a standardized measure. Then only, you're able to make a reliable conclusion, alright, or reliable decision. Okay, next, it should translate the measure of risk into rate of return that the investor should demand as compensation for bearing the risk. Okay, what does it mean? If you're a shareholder, alright, a shareholder, and the company is saying that the company is going to take a risky project, alright, when you're saying a risky project, you should tell the shareholder, we are taking 10% additional risk compared to our current existing business. Alright, now you're taking additional 10% of the risk. Therefore, in return, the shareholders will get additional 10% of compensation, higher return. Alright, so that is how it has to be translated. You cannot simply say I'm taking the company is taking a risky project, but when it comes to return, you didn't say anything. So it has to be there must be a relationship between the risk and also the return. It should work well not only at explaining past returns but also in predicting the future expected return. Okay, this is also important. Alright, risk and return should not only be used to analyze the past returns. The last 5 years, how did the company perform? How is the risk? How is it? It should not only be based on previous years or the past returns. It should be a measure to predict the future risk and return as well. Right? So these are the 5 points how a company could able to have a good risk and return model. Alright, next. Okay, so let's start with some calculation of investment return. Alright, the rate of return on an investment can be calculated as follows. Alright, so this is the most basic calculation of return, which is expected ending value minus the cost divided by cost. Alright, whatever your ending value minus the cost you have initiated, and then divide by your cost. For example, if $1,000 is invested and 1,100 is returned after 1 year, the rate of return for the investment is, alright, your expected ending value is 1,100 minus what was the initial cost. Your initial investment was 1,000, so 1,100 minus 1,000 equals to 100, divide by your initial investment or initial cost, which is 1,000. So 100 divided by 1,000 equals to 10%. Alright, therefore the investment return for this example is 10%. So that is the basic way of calculating return. Whatever the ending value, alright, minus your initial investment, initial cost, then divide by your initial cost. That's your return. Alright, so let's move on to the next. So what is investment risk? Alright, just now was the example of return. So now let's look at risk. Alright, there are 2 types of risk we'll be studying today. One is standalone, another one is portfolio risk. Alright, so we're going to see more in detail on the risk. Standalone means you're looking at that particular asset or that particular project, only one. Alright, you look at individually. Portfolio means combination of all the assets. Alright, so portfolio means combination of all assets. Standalone means one specific asset. Alright. Investment risk is related to the probability of earning a low or negative actual return. Alright, so this is basically the definition of investment risk. What is the risk? What is the risk from investing in a particular project or in a particular asset? The risk is the chances of you getting lower return or negative. Alright, let's just take same example as previously. Alright, you invested 1,000 and you expected to get 1,100, but instead of that you're only getting 1,050. Alright, you're supposed to get 1,100, but you only get 1,050, right? Which means what? Instead of 10% return, you only get 5% return. So that is a low actual return. On the other hand, you invested 1,000 intending to get 1,100, but let's say you're only getting 900. Alright, instead of 1,100 you only get 900. It means what? You are actually lost certain portion of your capital itself. So that is your negative actual return. Instead of getting positive, you are at the end of the day your capital has been decreased. Okay, so that is the negative actual return. That was the negative 10% just now. So the greater the chance of lower than expected or negative returns, the riskier the investment. Alright, higher the chances of lower negative returns, we call that as a riskier investments. Okay. Alright, so let's look at the probability distributions here. This basically listing of all possible outcomes and the probability of each occurrence. Alright, so it shows here there's 2 companies here, firm X, firm Y. Right? Both companies expected to get 15. Alright, they're supposed to get 15% return, both companies. But what is the probabilities? What is the chances? Alright, let's say firm X firm X has a very high chances, let's say 50% of chances getting 15%, and this is the lower probability. Let's say 25% chances of getting, maybe higher, maybe 20% return, or another 25% chances of getting maybe 10% return. Okay, so as it goes down, these are the probabilities. Could be 10% here, alright, it could be like 2% probabilities. Okay, so this is for firm X. As I mentioned, 50%, let's say 50% of chances of getting 15% return. Let's look at firm Y. Firm Y had the same expectation, which is 15%, but what is the chances? Let's say they might only have 20% probabilities of getting 15. Alright, firm X got 50% chances of getting 15% return, but here you only get about 20% chances of getting 15% return. What about it? Others? Maybe about 10% getting 10% probability of getting maybe 10% return, and it goes below. Alright, maybe now it's 5% probabilities, now it's 3% probabilities, now it could be 1% probability. But if you look over here, this is basically the negative one, right? And if it's below 0 on the left hand side, it means what? You're already making a negative return. You're losing your initial investment. Your capital itself is losing, and of course you have probabilities of getting higher than 15% as well, but it's a lower probability. So class, can you tell me which companies have a better possibilities of getting 15% return? Is it firm X or firm Y? X or Y? Which one have a better probability of getting 15% return? It is firm X, because it has a higher probability compared to firm Y. And can you tell overall which company, firm X or firm Y, has a higher risk? Do you think X have a higher risk or Y have a higher risk? It is Y, right? Because your probability of getting 15% is only lower, much lower than firm X. Not only that, you have the possibilities of getting negative return as well, right? Compared to firm X, they will be getting maybe slightly higher than 15% or slightly lower than 15%. That is the higher chances, but they are not going to get anything lesser than 0. Alright, so firm X has a lower risk compared to firm Y. Alright, so remember, the tighter, alright, if you can see, the tighter the probability distribution, lower the risk. Alright, so this is more narrower, this is more wider, right? So wider the probability distribution, higher the risk. So remember, tighter, the narrower the distribution, lower the risk, and this one, wider the distribution, higher the risk. Okay. Alright, so let's look at the return and risk, the relationship, alright, with different companies. Alright, so this is just an example from 1926 to 2007, how these companies, alright, those investments return and the standard deviation. So this is the average return and this is standard deviation. Standard deviation is a measure of risk. Alright, just start with the lowest one, US Treasury bills. Alright, so US Treasury bills and government bonds. Alright, so first US Treasury bills, the return is 3.8%. Alright, so very low return compared to those on the top. it has the lowest return. Why is the lowest return? Because US Treasury bills or government bond is issued by the government. When an investment, an asset issued by government, alright, it could be a debt, it could be a bond. When it issued by government, it has the lowest risk. Alright, it has the lowest risk. When it has the lowest risk, you give them a lower return. Alright, now you can able to low risk, low. You see, the risk is only 3.1%. Therefore, your return is of course lower compared to the one on the top, 3.8. The next, you have a long-term government bonds. You say usually treasury bills is short-term, alright, within a year. So that's why it's a low risk and also lower return. This is long-term. So long-term government bonds will be slightly higher risk, alright. And of course, since you're taking slightly higher risk, your return will be higher as well. Because every time you're taking more risk, you should be compensated with higher return. Right? Then you have long-term corporate bonds, companies. Alright, so you have Sime Darby, you have Gamuda, alright, all those companies, alright, they issue bonds. So this is the return and this is the risk. Okay? And then you have large company stocks. Alright, this is the share market. Your return is 12.3%. Alright, when you invest in shares, average you're getting 12.3%. But what is the risk? 20%. Class, what does it signifies? Higher the risk, it means the higher chances you might not get the return. Alright, higher the possibilities you might not get the return you intended, or even there are chances of getting negative return. Right? Of course, now let's say 12.3%. Next year, if the market is down, then the return might be only 5%, or could be negative results. To the extent some companies could go bankrupt. So that is a higher risk. Even further up is a small company stocks. It has the highest risk, 32.6%. See, almost 1/3 of chances you might not get your return. Okay, but on average they give the highest return. Why? Small company stocks, small company shares, alright, these companies are not well established, alright, so they need to attract shareholders to invest by giving them higher return. Only by giving higher return you can attract the investors. If not, they will just go for established companies, alright, large companies, or they will just go invest in bonds, alright, government bonds, because this is very low risk, right? Very low risk, and you might definitely gonna get the return as stated here. But as it goes up, higher the risk, higher the possibilities you get a lower return or negative return. Alright, so that is why you need to give them on average high return to attract. Alright, so let's look at the investor's attitude towards risk. Okay, first one is risk aversion. Alright, assumes investors dislike risk and require higher rates of return to encourage them to hold riskier securities. Alright, so if investors are averse or conservative, they prefer not to take risk, but they're willing to take riskier securities if you're giving them a much higher rates of return. Alright, so basically they don't like risk, but if you say we're going to compensate with a very high return, alright, then they're willing to take the risk. So that is risk aversion. So you cannot think that risk aversion means they are totally avoiding risk. No, right? They don't like risk, but if you tell them you're giving them a better return, then they are willing to take it. Alright, and then a risk premium, the difference between the return on risky asset and riskless asset. Alright, so that is called risk premium. So later on I will show you an example what is all about risk premium. Okay, so let's look and break down the sources of risk. Alright, so stand-alone risk comprises of two things. One is market risk, another one is diversifiable risk. Alright, so market risk is also known as systematic risk. So class, take note. Alright, because different reference book use different terms. Alright, so market risk is also known as systematic risk, is a portion of securities standalone risk that cannot be eliminated through diversification. Alright, and it's measured by beta. It means certain risk can be diversified. Okay, let's talk about diversify first. Diversifiable risk means portion of security standalone risk that can be eliminated through proper diversification. So diversification means you don't keep all your eggs in a single basket, right? Why there's a term on that? Why is the saying on that? Because if you keep all the eggs in a single basket and you drop it, you're gonna lose all the eggs. So instead of concentrating all the risk in a particular company, right, what do? You diversify. Let's say you have $100,000. You don't invest all $100,000 in a single company. Alright, if let's say you invested all your money in, let's say, Malaysian Airlines. If the company goes bankrupt, you're gonna lose every single money that you've invested. Right? Instead of that, let's say 20,000 you invest in AirAsia, 20,000 in SignDebi, 20,000 in Sunway, 20,000 in Digi. You diversify in different shares or different companies. What will happen? Even if one company goes bankrupt, you still get a return from other companies, right? So that is called diversifiable. Don't invest all your money in single asset, a single company, right? So there are certain assets, certain risks can be diversified, can be reduced, or to the extent some of it can be eliminated if you have enough diversification. But there are risks you cannot eliminate at all. Doesn't matter you invest in 5 companies or 10 companies, you will still face the risk. So that is called market risk. Alright, so of course we're gonna learn more on this in the upcoming slides. So let's move on. Alright, so class, this is exactly same thing as previous slide, which is your standalone risk is also known as total risk. Alright, your market risk is also known as systematic risk. I'm giving you both because sometimes different reference book might give you different terms, right? So systematic risk is also known as market risk, and systematic risk is also known as diversifiable risk. Alright, so again the definition. Alright, systematic risk you cannot eliminate or reduce. By unsystematic you can reduce, alright, through diversification. Alright, so let's look at the diagram here. Your total risk combines systematic risk and unsystematic risk. Alright, so this basically the line shows the total risk as the number of securities increase over here. Alright, here it's like you invested in a single company, you invest in one company. So what is your total risk? Your total risk includes the systematic risk and also the unsystematic risk. So if you invest in a single company, you look at your standard deviation. As I mentioned, standard deviation measures the risk alright, of an investment. So if you only invest in a single company, your total risk is very high, right? Because your systematic risk is the same. It doesn't change according to the number of securities you have in your portfolio, but your unsystematic risk or diversifiable risk will change as the number of securities increases. So if you have one asset, this is your total risk. When you have two, your total risk has reduced. When you have more, you see your total risk has been slowly reducing as your number of securities is higher. It's like, let's say now you have 10 companies. Alright, if let's say you have 10 companies, your systematic risk is the same, but your diversifiable risk is much lower. And let's say you have now 20 companies in your portfolio. Your systematic risk is the same, but your unsystematic risk is very low. Alright, so what are the ways to reduce your overall risk is by diversifying. Okay, so let's look at the factors for systematic risk. Alright, so systematic risk doesn't change. Alright, it does not change, depends on the number of securities you have in the portfolio. Whether 1 or whether 20, you still face the same amount of systematic risk. Alright, it depends on the changes in nation's economy, tax reform by government. Alright, previously you have GST, previously you have SST, then they changed to GST, now back to SST. Alright, all those tax reformation, whether you have 5 companies, 20 companies, you still have to face those situations or change in the world situation. Like currently we have COVID-19, so all those will affect your systematic risk. Alright, next slide you have unsystematic risk. Alright, so what is unsystematic risk? Factors unique to a particular company or industry. Alright, for example, death of a key executive or loss of a government defense contract. Alright, let's say in companies like Apple, when the founder died, what happened? The share market, the share price has dropped. Right, so it is only unique for that particular industry. It's not going to affect any other companies. Alright, so that is why factors unique to a particular company or certain industry. Like currently aviation industry or hotel industry is severely affected, but other industries, alright, if let's say food industry is still going on without any problems, right? So that is the unsystematic risk. Alright, so next slide shows the failure to diversify. If an investor chooses to hold one stock in the portfolio, he doesn't diversify at all, would the investor will be compensated for the extra risk they bear? Alright, so this is the question. Alright, let's say you really love one particular company. Alright, let's say you like company, let's say Digi. You love the company so much, and you have 100,000 and you don't want to diversify your money into any other company, you're only investing in one company. Alright, so the question is, would you be compensated with higher return since you're taking the extra risk? The answer is no. Standalone risk is not important to a well diversified investor. Okay, this standalone risk is not important to a well diversified investor because a well diversified investor would have already reduced the unsystematic risk. Alright, because if you have 20 companies in the portfolio, his diversifiable risk is actually very low. Alright, so that's why standalone risk is not important for a well diversified investor. For them, systematic risk is important. So what is the rationale? A risk averse investor concerned with the portfolio risk. which is based upon the market risk, right? There can be only one price market return for a given security. Alright, this is the RM. No compensation should be earned for holding unnecessary diversifiable risks. So basically this is the answer. You have the chances. Nobody's like force you to invest in one company. Alright, therefore this is the unnecessary risk you're taking. You could have diversified in many other companies, therefore you could have reduced the risk. Alright, so you won't be getting any extra return for it. Alright, so let's start with the first formula, capital asset pricing model, CAPM. Alright, so how do you measure it? Your required rate of return equals to risk-free rate plus beta market return minus risk-free rate. Alright, so your required rate of return is also shown as the formula below, risk-free rate plus beta times risk premium. RPM stands for risk premium. So what is risk premium? Market return minus risk-free rate. So that is your risk premium. So your CAPM is a model that describes the relationship between risk and also return. Alright, so this capital asset pricing model is one of the models you can use to find if a company taking higher risk, what is the return should be. Alright, because it has a relationship between risk and also expected return. Alright, so you calculate based on risk-free rate plus the premium on the systematic risk of the security. Alright, so the primary conclusion would be the relevant riskiness of a stock is contributed to the riskiness of a well diversified portfolio. Alright, so here you'll be only focusing on the systematic risk. Alright, therefore we assume the investors are well diversified.